This meeting is being recorded.
Everybody good? Happy New Year. Staying warm-ish.
Doing good. How are you?
I am awesome. I'm excited to share. I feel like I've got some decent information. So well, I want to be respectful of everybody's time. Is there anything before we get started that you're hoping to get out of today that that we can make sure that we hit? All right, you have to come up with at least one thing. I hate to pick on you, Todd, or Ben, you guys are the only ones with your camera on, which I appreciate, so I don't really want to pick on you, but I also know you're there.
I would just say the trend of interest rates sliding kind of went the other way the past week. So I'm just more curious your thoughts on next 6 months, year. Hard to predict, but
Cool.
Agreed. I'd agree with that.
Okay. Yeah, I mean, I would say that even if I do slip and make a prediction, I definitely wouldn't base my business on anything I say. But I think we can look. I have some information here on mortgage applications, and I think that is actually a really big leading indicator and also a good idea of like how that impacts. So we can definitely hit on that. So anybody else have anything before I get started?
I'm here. It's Emily. I don't think you want me to turn my camera on, but I always love your information and how it correlates to showing time and number of showings and price ranges and things like that. So hopefully that's in there. It usually is.
Cool. Yeah, we do. We actually have started building our own little graph. Actually, I shouldn't say we. I should say Allison has been building for me a graph that compares showings to the interest rate. So that I do have that updated through this week, which is shows some interesting stuff. So we'll definitely jump in. All right, here we go. So let me share screen. Maybe. Sorry, I think I've done this before. All right, can everybody see that okay? All right, so hopefully you're here for the January real estate market update. I see Sarah and Laura said, what are your predictions for activity in the spring market compared to recent past? So we can talk about that too. But we'll jump into everything. So a quick, I think most of you looking at the names probably already know who I am, but I've been in real estate since 2004 here in Central Ohio, Columbus area. And I'm also a real estate investor. I own 15 units, 13 properties, so just a couple duplexes, but mostly single family. And I also am a real estate coach. So you can follow me on Instagram or Facebook. I try to post. That's an opportunity for improvement for me. And yeah, I do, when I get a chance, try to share stuff of value other than my kids playing hockey, but I do share that too. So if you want to see that, that's pretty much my second full-time job that I pay to have. So yeah, so that's that. So today we're going to cover market trends. So we've got the kind of everything split into two separate sections per normal. I know because we're doing this through the One Team network, we have some people on that aren't necessarily in Central Ohio, so I like to split it up, looking at the national trends. And then I'll go through kind of my thoughts on the overall market and then jump into the Columbus specific trends. So anybody who isn't interested or concerned with what's happening in Columbus can jump off at that point. And the parts of that, I've got some economic news. So what inflation's doing, also how can we use lending and the builder stuff to keep our business growing, and then what things we should be watching in the economy, and then lastly, kind of my opinion of the market. And then I guess the final thing will be the Central Ohio inventory and selling trends as well. So let's jump right in. Active listing count, and obviously we're always kind of a month behind, I guess, or 2 weeks behind at least when we're in the middle of the month. We get all of our national data currently that I present from realtor.com. So if you just Google like realtor.com stats, you can go in and get and find all of this. If you ever have trouble finding where it is, text me, or actually better yet, email me, and either myself or Allison will respond back with a specific link. And just the last reminder before we jump in, if you want the slides, please either put it in the chat, or you can email me at troy@marshhomegroup.com, and Allison will send those out to you, and we'll also add you to our calendar invite every month so that you can have it in your calendar and you don't forget about us, because we know that this is just such amazing information. So anyways, all right. Listing count, active listing count was up 4.9% year over year at the end of December, which, as we know, if you look at these 3 lines from the 3 previous years, we're well below kind of what we considered normal in the late teen years. And so moving up towards that number is definitely a good thing for those of us that depend on having a certain number of homes to sell to buyers. And last year, that was well below normal, as you guys know. Pending listings were down a little bit compared to 2019, which is interesting, but still on the higher end compared to most of the historical averages. So that was a good thing. Obviously less than 2021 and 2020. But you would expect that, since the second half of 2020, along with all of 2021, were probably the most robust real estate markets that, we may ever see in our lifetime. Hopefully not, but definitely over the time that I've been in the business. Newly listed homes were also up 9.1% in December compared to December of 2023 or 2022, I'm sorry. So also another really good sign that we are trending in the right direction from an inventory perspective. And I think for those of you that join me regularly or do your own research or have just been in the business, obviously, our biggest challenge in 2023 was absolutely just having enough homes to sell. Up until fall, when interest rates got into the high 7s and we saw buyer activity dip. But the story of the last couple of years has absolutely been, we just have not had enough inventory, and that's been largely driven by the fact that all these people have locked in those 2 to 3% 30-year fixed interest rates, and they just don't want to give those up and trade those in for a 6 or 7 or 8% interest rate. So to see these numbers ticking up off of the lows is that sign that I think we've been looking for, that the buyers or the sellers are starting to respond to life and not just interest rates, although we still have a lot of people that are stuck wanting to stay put because of the rate. Days on market was down in December compared to December previous years, but again, those are the sold properties, and so just keeping in mind that that's really an indication of what might have been happening in October and November. Median list price. So realtor.com does not share the sold prices. One of the reasons why I've noticed a lot of places not paying too much attention to sold prices is because when you're looking at activity for the actual month, it's really a big sold prices are a huge lagging indicator, right? The sold price in December is really telling you what the market was in October and November. So you do have to be kind of cognizant of that, but prices were up slightly over last year, 1.2%. And again, that's nationally. There are some markets in the US that are extremely slow right now. Austin, Texas is probably the worst in terms of the decline in both prices and overall activity, which has led to a more healthy inventory environment there. But some of those areas that are slower have definitely impacted the trend. So as you'll see, our numbers are a little bit better, actually a lot of better than that in December. But we'll get into that later. Price reductions were down 1.4% compared to last year, which is largely irrelevant in my opinion, but just kind of in the middle of historical trends, which is a pretty good place to be. I mean, I think we're kind of right where you would expect us to be. And as we trend towards a more normal market, I think that's good for overall sales, which again, for this group, I think most, if not all, of you depend on overall sales being high in order to keep increasing your income. And so we definitely want to trend towards a more normal inventory environment. Here are the 50 largest metros combined. You can see broken down by region. You can see active listing counts. We're higher in the South, about the same in the Midwest, and then lower in the Northeast and West. The median listing price, however, was up in all regions, which is interesting. And then days on market were kind of down slightly everywhere else. And this is, you guys know I talk about this. I pretty much put this in here every month because I just think it's super interesting to compare new listings now versus pre-pandemic, which would be like the 17 to 19 time frame. And you can see Austin, Texas was the one city I called out, but I know Atlanta's also been slower. And I think in general, the South kind of led the way during the COVID years in terms of growth because people could relocate and keep their job in the cold areas. And that's shown here by the median list price being one of the highest. The Northeast was actually the highest, which is kind of interesting because no one really talks about the Northeast. But the South, the median list price was up 34.3% compared to pre-pandemic, which was the second highest. So yeah, I don't know that I have a ton to say about this. It's kind of been the trend that we've been seeing, but interesting to just kind of keep an eye on it and make sure that trend is continuing. All right, so interest rates. So this is as of yesterday. There wasn't a huge change. It bumped up a little bit yesterday. But Todd, to your point, we have seen a little bit of a bump. As you can see, the blue line is Mortgage News Daily, which kind of takes everyone into account. So even though we have seen a little bit of a bump up, and we never, if you're somebody who watches this daily, like to see a bump, you know, if you watch Mortgage News Daily, you hate to see the red color, right? But at the end of the day, the bumps up have been largely pretty small. And when you think about pricing and the fact that most mortgage lenders, all of them, to my knowledge, go in 1/8 of a percentage point, like most days when it's negative 0.02 or whatever, like it's not making enough of a trend to even typically change the rate that the lender is offering, right? So we obviously don't want to see an upward trend, which I would say you see slightly kind of since the beginning of December, honestly. I would say this is more of a sideways trend. You could easily see a change down in one day on this. The bigger thing that I'm looking at from just a trend perspective is this trend right here, right? Like we're obviously well below the highs, and really we have to go all the way back from Mortgage News Daily to almost like end of May, beginning of June, to when we saw rates between 6.5 and 6.75. And so that's the thing that I think is going to drive the spring market. The other thing is that in general, obviously people like downward trends, But what we've seen over the last couple of years with very volatile interest rates is that actually consumers tend to feel most comfortable taking action when rates are steady. So even a big downward trend, people actually tend to push the pause button a little bit because they think like, I wonder if rates are going to go down even more, right? And so when we have kind of a sideways trend like this, it actually typically instills confidence in the consumer that, hey, it's okay to go ahead and go buy because rates aren't really going to go down a lot, but they're also not going to go up a lot. So I can kind of budget and make what I would consider to be a sound financial decision. So overall, I think this is not a bad thing at all. And we'll get into in a second kind of additional trends. But my overall prediction from listening to people that are a lot smarter than me is that we're probably going to stay in the 6 to 7 range for the majority of this year. I mean, there is a scenario if we went into a deep recession where we might see rates dip below 6. But I would guess for the 30-year fixed trend, we're probably pretty much 6.5 on average is what I would be telling people to expect. But I also don't anticipate, especially with the recent economic data, which we'll get into here in a second, that rates are going to go much above 7. And I really would be surprised to see them go much above where they are right now for any significant period of time. All right, mortgage payment changes. Again, you guys, we've beat this drum to death, I feel like, but it's always something that worth refreshing, I think. You know, the difference between that 3.25% rate and 6.5 on a $600,000 loan is $1,200 a month. So it's real money for our clients, right? The difference between a 6.5 and 7.5 is way less of a difference. But for some people who are super payment sensitive, it can be enough. I think the difference between a 6 and a 7 on the front end is more significant than anything else. If we were to dip and put a 5 in front of that, which is actually attainable today with some lenders with FHA and VA, I think that makes an even bigger difference. So overall, I think trend is positive on the interest rate thing. Does anybody you can either type in the chat or unmute if anybody has any comments. I know in general, I think our market and the national market in general in real estate is almost completely driven by rates. So even though this is a relatively small part of the presentation, it may be the most important 5 minutes. So happy to answer any specific questions if anybody has one before I move on. No? Okay, I'll move on.
Hey, Troy.
Yeah, yep.
This is Sarah. So when you mentioned FHA and VA, are you taking into account the fact that FHA has permanent PMI or that VA has the what's
Funding
the word?
fee.
Yeah, the funding fee. So with all that taken into account, I'm just curious, is it more competitive or kind of the same as a conventional loan?
I think it depends on the borrower, because if somebody's putting less than 20% down, they're going to have PMI to pay on conventional. And I think it also depends on the lender. I know most lenders don't have closing costs equivalent to funding fees, but some lenders, I've been seeing some crazy high numbers on some offers here from lenders who are wanting some pretty significant compensation. So I would say compared to the lenders that charge low fees, you're always going to be better off going conventional if you can. But I also think the benefits to FHA are that it opens things, the mortgage insurance factor had risen. When was that? Like in the late teens, maybe mid-teens. They increased the mortgage insurance premium for FHA buyers pretty significantly. And then last year they lowered it quite a bit. And so if you haven't priced out FHA for a while because it was hard to get an offer accepted, it's definitely something worth looking at. FHA and VA also allow for higher debt to income ratios, which we could go down a bunny trail with whether that's a good thing or a bad thing. But at the end of the day, if you have a buyer who's on the fence, they may not be able to get approved conventional, but they could easily get approved for FHA or VA and maybe for more money. And so if you have a non-competitive situation and you can get FHA and VA accepted, you may be able to actually get higher in price just because of the lower rate and the higher debt to income ratio allowed.
Do you think it helps to show, though, if you're presenting an FHA or VA offer, that they can qualify for conventional?
Absolutely. I
Okay.
think it does help if you can. And that does bring up a good point. For those of us, well, and even if you haven't been in the business a long time, you should use this. Unfortunately, both sellers and agents are poorly educated in most instances on FHA and VA, and a lot of them think that conventional doesn't have the same challenges. I mean, I will tell you that I bought an investment property with 25% down, conventional, a couple years ago, and the conventional appraiser made me add a handrail to the 2 steps leading up to the house from the street. It was downtown. So I think a lot of people think that FHA and VA are the only ones that require repairs by the appraiser. Do I think that they're more common with FHA and VA? Yeah. But don't kid yourself in believing that a conventional appraiser, who is what I like to call a save the world appraiser, can't come in and create a list of things that you have to get taken care of, whether it's a structural certification or a roof certification or have mold looked at or those types of things. I've actually had more problems with conventional appraisers on investment properties or properties that need work than I have with a lot of FHA appraisers. So, does that answer your question?
Yeah, and I agree. I had a lender who I was the buyer's agent, and in the middle of the home buying process, we actually had to change our loan from conventional to FHA because the rate was so much better on FHA for her that it was going to save her a ton of money. And the seller really didn't mind, but except for the appraisal portion of it. And the lender reminded me that, and I don't know if she said a couple of years ago, they changed their qualifications on appraisals or whatever, but anyways, it was a really smooth process, and FHA, it didn't hold us up at all. But I would be interested to see if they did change their guidelines for appraisals to be more in line with a conventional appraisal, or if it's just they're easing up given the market.
Yeah, they did change their guidelines.
Okay, thank you.
But a lot of the appraisers were already, I mean, what most people don't realize is that overall the appraisers actually have a lot of power individually. But also the second part of any appraisal is the underwriter. And the appraiser, I know sellers get annoyed because the appraiser comes in and spends 15 minutes there and all they do is take pictures. But you have to understand the appraiser's pictures and the comments on those pictures drive the underwriter's requirements. And so oftentimes the appraiser is truly just documenting the condition. And then the underwriter is the one that requires those things to be completed or not, depending. And so, like, for example, I'm sure that some of you have had an appraisal repair issue come up where they allowed you to just take a picture of it and send it in instead of having the appraiser have to go back out to the property. Well, that has nothing to do with the appraiser or FHA guidelines. That has to do with the lender and whether they'll consider a picture or a receipt to be sufficient or whether they require the appraiser to go back out there and document it. So yeah, it's interesting and they're good questions to ask as a listing agent when you're accepting an offer, or when you do get an appraiser that requires certain repairs. up front, I'm always asking, okay, what has to happen specifically in order to satisfy this issue? Because you could talk to 3 different lenders and get 3 different answers, and at the end of the day, that's what you're required to do.
Thanks for going into so much detail about that. It's really helpful.
Yeah, absolutely. I had another question from Mindy. Are you talking with clients about the cost of waiting for the rates to drop, how much money they'll be paying later with down payment and monthly payments? I think absolutely. I've always felt a little bit uncomfortable with assuming to clients that rates or that prices are going to increase by X% over the next 12 to 24 months. Call me somebody with PTSD, having gone through 2008 to 2012. But, you know, the reality is that prices don't go up every year in infinity. Now, is my opinion that they will? It is. However, I think putting in graphical presentation to say, this is why you should buy today instead of waiting 6 months from now, is that I'm essentially guaranteeing that the price is going to go up by X%, and therefore your down payment is going to increase, et cetera, et cetera. I think it's a good example to show them. And I think a lot of people wish that that would have been more in their face 5 years ago. But I also think that hindsight is 2020, and just be very careful from a relationship perspective about guaranteeing appreciation, because it's not always the case. And so I think that, again, it's okay to have an opinion, but make sure they understand that it's an opinion and not a guarantee. And it will open some people's eyes. I like to focus on the fact that over the next 5 years, your appreciation is going to be XYZ. And so you're saving yourself the cost of rent and all of those other things in the short term, but not necessarily guaranteeing that if you wait, you're going to be technically paying more. So. All right, so mortgage applications. This is something that I pull from Mortgage News Daily. I usually put the source on here, so I'll verbally give it to you. But applications, this is actually just from this morning. Mortgage application volume increased by 10.4% from last week. And it's on an unadjusted basis. Week over week, it rose 26%. This was largely, though, driven by refinance. So it was 11% up from the week before, 10% higher than a week or a year ago. And refinancing accounted for 37% of the total applications, which is definitely higher than it had been when rates were higher. The purchase index was actually down 20% compared to last year at the same time. So take that for what it is. I don't know that this is a trend that we need to be worried about. It was up compared to last week, but definitely still lower than last year. I like to look at mortgage applications as a leading indicator. It's showing how many new buyers are entering the market. And so we definitely want to continue to see that number climb. And so, yeah, there we are. All right, so being the local economist of choice. So this, I know, is going to get into the weeds. Some of you are going to gloss over a little bit, but I do think it's important when we're talking to clients to understand at least a little bit of what's going on in the economy and what's driving the rates and the rate behavior. So last week we had consumer price index, which is basically inflation at the consumer level, and then what they call the producer price index, which is essentially inflation at the wholesale level. Both of those numbers came in lower. The core CPI, which is what you and I pay when we go to the grocery store, that actually, well, yeah, the grocery store technically isn't included in the core, but basically the trend is definitely down, but the wholesale index was way down. And that's something to keep an eye on, because typically the wholesalers, what they're paying tends to bleed into and be a leading indicator of what we pay. It'll be interesting to continue to keep an eye on this, but the trend overall is good. You can see last year, we saw a couple dips and everybody got excited about these dips, and then it kind of went back up again. This year, or not this year, but in the last like 6 to 8 months, we've seen a pretty continuous trend downward in the inflation number, which is what the Fed wants to see. But you can also see there's still a gap. So if you ever look at headlines, the Fed says there's still more work to do. And so they're going to be very data dependent, is what they call it, on seeing that number continue to decrease. Again, this is a little bit in the weeds, but I just want to explain. So Fed funds rate, as you guys remember, that's what short-term loans like credit card loans, auto loans, those type of things are based off of. That's also what the Federal Reserve, when they come out and say we lowered rates or raised rates, that's the rate that they're talking about. And so what this is on Wall Street, there's like basically somebody that tracks, it's almost like betting on how low the rate's going to be by the end of 2024. And so certain pieces of economic news make that bet go higher or lower. You can see when the consumer price index came out, it kind of went up and down, kind of stayed the same. When the producer price index came out much lower than expected, you can see everybody's expectations of rates by the end of the year dropped a decent amount. So ultimately, what this chart is showing us is that the data that came out last week, this was a little bit less exciting. This was more exciting, leading to lower rates. And although this doesn't specifically tell us what's going to happen with mortgage rates, typically the short-term rate trends are followed by long-term rate trends. And then this was another thing that came out today. Again, you don't have to think about this really after I say this out loud, but the New York Federal Reserve had a manufacturing study where they look at manufacturing activity just in the state of New York. And the interesting thing was the number that just came out this month was the lowest number in the last 30 years of manufacturing activity outside of 2020 during the COVID month of April. So what does that mean? It may mean nothing, but I think you can see an overall trend down. And when you compare that to even the Great Recession, the fact that we're seeing low numbers, just more flashings of a potential recession in the near term. And why I bring that up is because we have to kind of figure out whether the recession is going to help us or hurt us. It'll certainly add more inventory to the market, but if all the buyers leave, it's not necessarily a good thing. And typically a recession causes people to slow down. So recession, yes or no? I would say that economists who are way smarter than me are still split on the topic. I have been seeing more yes after the first of the year, after seeing more no's in like November and December. So we'll see, are the rates going higher or lower? I think they're going to still continue to trend lower, but I think they will stay higher than most of us would like longer because inflation seems to be persistent. And although I don't have any information on here, for those of you paying attention to global things, there's a terrorist organization, whatever you want to call them, in Africa that's firing missiles at cargo ships in the Red Sea. And as recent, I saw last night a headline that I guess 2 Navy SEALs are missing in the Red Sea, or were at least last night. So if we have any kind of significant like war or conflict, obviously we've already had the Israeli-Palestinian issue as well. Those throw wrenches in things that come sometimes out of left field. And then we also have the presidential race this year, which also has an opportunity to impact rates. So I think be careful with predictions this year. And that's why I kind of stress that with prices as well. Just a couple points, ways that you can leverage this information. I do think builder incentives with even lower rates now that the main par rate is getting down into the sixes. We're seeing more and more builder incentives that are going into the fives and even fours. So use those to your advantage for payment sensitive buyers. And then also it's more important than ever, I think, to know your local lenders, because lenders are offering both different rates as well as different products that sometimes offer lower rates. So keep an eye on that as well.
Troy, you've referenced a couple of times people who are smarter than you. Do you recommend any podcasts or resources that you really turn to, like top 2 or 3?
Yeah, I would say, yeah, that's a great question. I should probably just throw a slide in here. I would say Mortgage News Daily is really good at, writing really short articles. If you want to watch a couple podcasts, Bigger Pockets has a podcast called On the Market, which, and then also, I can't remember, it's Housing Wire is who the guy works for. But he does something on rates like every day. And then the last one is Mike Simonson, I think, from Altos Research. He does a weekly YouTube thing that's like 10 to 15 minutes long. And then once a month, he does an hour. Those are probably my like top 3, with Altos and On the Market being my top 2. I just recently heard the guy from Housing Wire on the Market. And so I started following him as well. But those are the 3 that I follow. There are a bunch others out there, but this Mike Simonson, he does that 10 to 15 minute thing every Monday. I've found to be extremely valuable in just getting a pulse on the overall market.
So you said Housing Wire Daily on the podcast, and then what else?
And Mortgage News Daily. I put it in the chat.
Okay. Oh, thank you.
Yeah. So I guess those are the 4. Okay. My quick opinion, I think I've said most of this already, but buyer activity is definitely on the rise here after the first of the year, both locally and nationally. So are new listings and pendings. We talked about target interest rate. This is the one thing I haven't said, but I heard somebody say it the other day and I was like, oh, that makes a ton of sense. Every year, 4 to 5 million people will be buying homes at higher rates, right? And so every year, 4 to 5 million people no longer have a 2.5% to 3% mortgage rate. So the percentage of homes that have those higher rates is going to continue to go down. And so over time, there are going to be fewer people that are using rates as a reason to not move, even if we continue to have higher rates. And I kind of referenced this before, but the best question I think to ask people in this market where there's a lot of uncertainty is, what's the likelihood that over the next 3 to 7 years that home prices will go down in your area? If you as an agent, or most importantly your buyer, do not think that that's a likelihood, I would use that as a reason, like just buy now. Yes, there could be some short-term ups and downs, but overall 3 to 7 years from now, you're going to be most likely in a much better position. Even in 2008 to 2011, after 2011, prices started going up again. So 3 years during what is arguably the worst housing recession ever, was the longest that prices actually went down. So the shorter the time horizon, the more risk there is. All right, any other questions here before we move into Central Ohio? No? All right, either you guys are all sleeping or I did such a great job. So either one, I guess, is okay. All right, jumping into Central Ohio. I would say the biggest thing that we're looking at is higher inventory. And I'm only going to spend a second on this slide because this is looking at December. So we're up 8% over last year, but the new listings were down a little bit. Although because listing volume is so low in December, you can see it only amounted to like 70 fewer homes. But it does make a difference that all the properties count, right? But the number for sale so far this month, so this is through the 15th of January, is actually up 32.9%. That's significant. All right. So that equals just a little over 500 more homes on the market this year than last year at the same time. So we would anticipate that that's going to translate into both the pendings and the solds. And then you can see even the new listings so far this month are up as well, which again is all good news. And these are all in the resale market. If we come down to new construction, inventory is up 8.1%, which we all know isn't a super, valid number since a lot of new construction is not listed on the MLS. We see 6.4% fewer new listings have been put on the market this year compared to last year, but the number of pendings in new construction is up 36%, which is a similar amount to the resale numbers. So overall, good news with more inventory. The number for sale, boy, oh boy, sorry, this did not get changed, but this is December to January, kind of irrelevant. I like to look at the previous stuff, which we've already talked about, so I'm just going to skip over this. 26 days on market, which in December, which happened to be exactly the same number as last year. So not a ton of news. Actually, November was exactly the same number. So definitely trend very similar to last year. I think if our first quarter trend continues to be just like last year, we'll be sitting in a pretty good spot with a lot of buyers wishing that they would have bought in the fall when rates were high and then just refied, because we started getting multiple offers last year. And from what all of you are saying in the Facebook group and other places, and what I'm seeing in the market personally, that kind of market is back for a lot of listings. Current inventory 1.3 months, so we're a little bit above where we were last year, which again is not a bad thing, keeping in mind that a balanced market is still 4 to 6 months of inventory. So we're still seeing a seller's market, and that is a good thing. This is new construction. Again, right around 3 months of inventory, which has been pretty consistent. But again, it's hard to gauge that off the MLS just because not all new construction is in there. Here's something that's interesting. Obviously, we have a lot of blips in the radar. But if we look at last year, typically in December, we kind of see a drop in average sales prices. And actually the sold tends to drop through January because that's what was happening in November and December, which tend to be a slower time of the year. And what we see this year is that actually December was up over November, which is a trend in the right direction and kind of abnormal. You can see how much seasonality happened last year with pricing in the fourth quarter, and this year the trend was there, but the steepness of the curve was a lot less. So we could see some decent price growth based on that kind of line there year over year once we get into the spring and summer, if we continue like we did last year. So we'll see. But December average sales price was up 9.6%. The change from November to December alone was 2.5%. I wouldn't take that to the bank or probably guarantee that, but definitely trending in the right direction. I like to look at that more as a trend, up or down, than anything. Here is the information I was talking about earlier. So interest rate versus showings. So basically how we come about this data is Allison looks at the number of showings in the total market each week and then compares it to the interest rate on this day, according to Mortgage News Daily. And so what you can see is that after the first of the year, we've seen an enormous uptick in overall showings. Not a super big surprise, but on the same token, we haven't seen a trend really as much of a trend as I expected to see. Although if we look at the two lines, they kind of do, move together. But I think this will start to be more relevant as we move into a time of the year where we don't have drastic demand changes on a normal basis. Obviously, the difference in activity from December to January is traditionally pretty big anyways. So I think as we move into the end of the month, into February, this will become more valid. But it's data that's not published anywhere else, right? And then rents have definitely flattened out. So you can see month over month, rents do the same thing as home prices. They tend to go down when you get into the summer or winter months. We see our rent appreciation happen in the spring and summer, just like with resale. But you can see year over year numbers are still up. The average one bedroom in Columbus, according to Zumper, is actually up 11%. This is more in line with what I've been seeing, probably a more modest and what we would call normal appreciation of 3 to 5% on rents, which is pretty normal. So this will be valid for all your investor friends that want to know, should I expect an increase or a decrease in rents? So that is all I've got from a slide perspective. Anybody else have any questions at all that we haven't already gone over? I think I got everything in the chat. Okay, has anybody seen, like, I guess, why don't you guys put in the chat for those of you that have had listings since the first of the year, like how much from a percentage basis are you guys seeing with multiple offers? Was somebody going to ask a question? No? Okay.
Roy, I did have a question on a different topic.
No, go ahead. Nobody's rolling, so go ahead.
So the refinances are up because I saw that in the news, but it doesn't seem like the interest rate dropped enough for everybody to go out and refinance. It kind of surprised me. Is it purely a 1% drop is inspiring enough people to go refinance?
So I would say, and I don't have the data to back this up, but it's just from listening to people and then also just thinking through it. I think that what we're seeing are some people that, like, we know that consumer debt has increased a lot, but 7 to 8% rates have kept people from going ahead and doing a cash out refi because they just can't stomach a 7% rate. But the reality is that credit card rates are like in the 20 to 30% range right now. And so for a lot of these consumers that have way too much debt, I think that we're going to continue to see a trend, especially if the recession thing happens and we start to see an impact on jobs, that people are going to be forced to refinance versus what maybe in an interest rate stable environment, they would sell and move into a lower price property. But the problem is that lower price properties don't exist, right? And rents are also high. And so the only option people have, let's say their credit card and car payment is $1,500 a month, by going from a 3% to a 6.5% rate, they can pay off all their credit cards and their car and only increase their mortgage payment by $700 a month. They're doing that. So they're taking what is short-term debt and turning it into long-term debt. That's a whole nother class on whether, well, it's not a smart thing to do in the long term, but if your choice is to sell your house to have those funds available to get out from underneath that, but then have to go pay more in rent every month than your mortgage payment was, that also doesn't make sense, right? So I think what we're going to continue to see, and if we see jobless numbers start to increase, which we really haven't seen at a high level, unfortunately, I think we're going to see a lot more of this. But in 2008, people didn't have equity because we hadn't seen the appreciation that we've seen over the last 3 years. Right now, there's so much money tied up in people's homes that you're going to see people start going back. And it was a phrase that was thrown around a lot from 2008 to 2012 where we're going through it. They're going to be using their house as a piggy bank. There's a lot of money in people's piggy banks right now. And they're spending a lot of their income paying interest to credit card companies and other short-term companies. And so I think we'll continue to see refinances happen because of that. Not that that's a great thing, but I think we'll continue to see it. And you have a small percentage, to your point, of people, but the reality is the percentage of people that have a 7+% interest rate isn't big enough, to your point, to warrant a 35% increase in refinances.
That totally makes sense now. I never even thought about the personal debt or using those options.
Yeah,
So
and if
that
you
totally
go
makes sense.
watch, if you go watch any of like the mortgage coaches, the mortgage originator coaches, they're all preaching the same way that we're talking about how if you wait and prices go up, your down payment's going to be more. They're preaching to increase business. And it does make short-term financial sense. And again, we don't need to debate here whether it's the right thing or the wrong thing, but mortgage lenders are definitely pushing the idea of consolidating debt into your house.
Hey, Troy, it's Steve Smith.
Yeah.
To that point, I think the Fed mentioned they were going to drop the rate 3 times. That just kind of put everybody back on the fence. That was starting to see rates trickle down a little bit when they said that. Everybody's going to wait for a better day to refi, because they think there's 3 rate drops coming, but that'd probably be closer to the election. So, in my opinion, but
well, and I think the education opportunity there is that people like, I'm amazed at the number of people who are within the industry, within our industry, and then also like similar industries, like even financial advisors who, in my opinion, should understand this, but many don't, is that the Fed funds rate is not the same as mortgage rates. Like those 3 drops that they're talking about, that's the reason why rates came down from 8% to 6.5%. So mortgage rates are market based, which means that as soon as the market believes that rate drops are going to happen, mortgage rates tend to move immediately. Those Fed funds rates, I mean, and maybe we should go back, and I think maybe at one point I had something like this, but typically when the Fed drops rates, mortgage rates don't, like, it's already baked in. And it happened on the increase too. Now, there are also other factors that come into play with mortgage rates. But yeah, I mean, I would say those 3 to, I mean, there are a lot of like Merrill Lynch and some of those guys. Goldman Sachs is another one. There's 2 or 3 of those big global banks that actually are all betting on six rate cuts because they think that there's going to be a recession and things are going to get significantly worse than what the Fed does. I also think that I know that the Fed, if you go back and study history, the only time we've had this kind of inflation was in the late 70s and early 80s. And one of the things that happened back then was the Fed dropped rates too quickly. And then we actually had a bounce back recession where inflation spiked back up again. And so then that was when they had to really crank rates up. And that's when all of us have heard the stories about the 18% rates. But so the Fed is leaning towards like saying that things are going to be harder longer because they don't want to create, as soon as they say that rates are going to drop 6 times, you're going to see the stock market skyrocket and everybody's going to start dumping cash into things and go crazy. And the Fed is trying to not have that happen. And so I think they're going to continue to be very conservative on what they say and predict. But ultimately, if we see a major recession, especially if we see unemployment start to increase, with it being an election year, we're going to see more than 3 rate cuts. Because, yeah, I won't get into politics, but I think he's going to need the help if that happens.
And to your other point or question about offers, just a plain city 225 listing, there were like 16 showings one day and had 6 or 7 offers, and it went up into 280, I think, 285,
What
so
was the list price?
2.25.
Oh, wow. Okay.
Yeah.
There you
So
go.
this is a market in Plain City where there's not many resale houses, especially in that lower end.
Mhm.
So now 450, 500 listings out here don't get that kind of activity, but anything affordable is going to get a lot of play and cash offers because parents are helping family members out to get something that's affordable. So
Yeah, I was talking to an agent this morning who has a listing coming up in Olentangy that's coming soon. I think it was in that 500 to 600 range, but he's already got 12 showings set up for day one in Olentangy, which tends to not get busy until spring, just because people like to move with, around the school calendar. And so that was a significant thing for me. So,
is that a single family house?
uh-huh.
Yeah, that's affordable housing in Olentangy.
But 12 showings hasn't been the norm, let's put
No.
it that way, over the last 6 months. So it's a significant increase to what had been normal.
Yeah. Hey, thanks for the presentation. Good stuff.
Yeah, absolutely. Anybody else have anything before we jump off? No? All right, cool. Well, thanks as always for coming. Like I said, Troy at marshhomegroup.com if you want the slides. And Allison will also add you to the calendar invite so you guys know when our next presentation is. All right, thanks, guys. Have a great day.